Hello everyone, this is Amit Dharnia. I'm a director with Accounting Advisory Services. I'm here to share with you the methodology we'll be using for delivering lectures on IFRS. So how we are going to learn, like what is important and what is the way we'll be following so that you learn IFRS and also you're able to get insights on IFRS. So we'll be learning IFRS in the form of standards. So we'll first have a look at all the asset standards, that which are the various asset standards and how to classify an asset. So we'll be dealing with like a property, plant and equipment. The standard which is dealing property, plant and equipment is IAS 16 property, plant and equipment. Now how to differentiate IAS 16 property, plant and equipment with other standards which are based on assets. So if we talk about intangible assets, the standard which governs intangible asset is IAS 38. The standard which governs investment property is investment property. There are other standards. Now in IFRS there are asset standards based on the intention of the management, that for what purpose they intend to hold an asset. They intend to hold an asset for consuming into the business, they'll be following IAS 16 property, plant and equipment. It is an intangible asset intended for consuming into the business, IAS 38 is the standard. Now if they plan to invest this money in the form of capital appreciation or for renting it out to others, if they invest money in land and building, now there is a standard especially for land and building investment property, that if you are investing money in land and building which you are not going to consume into the business but you plan to earn out of rentals or earn in the form of capital appreciation. So you need to classify it as IAS 40 investment property. You cannot continue to show it as part of your fixed assets. Now among your fixed assets, if you have thought of selling any asset within 1 year, now there is a separate standard which talks about IFRS 5 non-current asset held for sale. If you are dealing with inventories, the standard which talks about inventories is IAS 2. Inventories. And if you wish to know whether you are constructing a qualifying asset or not, and if you borrowed any funds specifically for construction of this asset, can you capitalize the cost incurred on this asset? IAS 23 is the standard borrowing cost. So we'll be learning all these standards together so that we are able to differentiate between them, what is the intention of the management, and also be able to know that how IFRS uses different terminologies and methodologies to record an asset in the balance sheet in the form of a current asset or a non-current asset. Then if we have entered into leasing arrangements, there is a standard, it was earlier known as IAS 17 leases, and IFRS 16 leases is the new standard. So the methodology is that before every session we'll first have an overview of the standard, have a summary of the standard, then we'll look at the PowerPoint presentation. In the end we'll compare the difference between IFRS and Ind AS and also do some practical questions relating to it so that we get a complete grasp on the subject. We are not only knowledgeable in terms of the content, we are able to apply the knowledge and can relate it to various standards and can also understand the techniques used in the examination to do calculations or apply it practically in the examination as well as in real life. So if I talk about assets, like now if I talk about financial assets, it's governed by the IFRS 9 financial instruments. Now how will I differentiate? How will I provide you a summary of financial instruments? Now this is considered one of the complex standards, but if we break it into pieces and understand it in detail, we can easily grasp any standard. So if I talk about IFRS 9, like there are two categories. A financial instrument is an asset of one entity and liability of another entity. Now there will be two categories, one is financial asset and one is financial liability. If I talk about financial assets, they are recorded in financial statements either in the form of debt or in the form of equity. Now the question arises how to record an item which is recorded in the form of a debt in the financial statements, an item which is recorded in the form of an equity, that we have invested in giving capital to an entity in the form of debt. We have invested in the equity shares of an entity. Now, how to record this asset into a financial statement? Now, this debt will further see whether it is contractual cash flow, and we can know the future contractual cash flows, we can know the effective interest rate applicable on it. If this is the case, if they are financial assets which are held to maturity, which we know we are going to hold for a period which is going to cover the maturity period, and we have intention of solely receiving payments of principal interest. If it is meeting, so there is a category known as SPPI category, that if our intention is to solely receive payments of principal and interest, it is meeting the SPPI category, and it's only payments of principal interest and not exposure to any market risk. We can predict the cash flows being received, so we'll be measuring it at amortized cost. But if we are holding such debts, but we also intend to sell, the intention is to receive contractual cash flows, but may also sell. Now the accountant will get confused what to do now. Now if this is the case, if you are holding some financial assets which your intention is to hold them till maturity, but you may also sell them if required. So if that's the case, there is a category known as fair value through OCI. You will not show them as part of your P&L, you will route them through OCI, and on settlement you can reclassify them to P&L. Reclassify them to P&L. The third category is that you're not intending to hold them till maturity, your intention is to sell them. If your intention is to sell them, the only category left is fair value through held for trading. If you're holding them for trading, that means you're exposing yourself to risk of fall in value, and you may also gain in value because your intention is to trade them in the market. So the third category is FVTPL category. Now the standard on financial instruments guides us when to record a financial instrument, classify it either as a debt or equity. If it is a debt, we need to further know whether the intention is to solely receive payments of principal interest or the intention is to hold it for trading. Now depending on the intention of the management, our accounting follows. Now if it is equity, equity is never at amortized cost. So the only option left to us is fair value through P&L. Now there are companies who say that our intention is to hold this equity instrument for a longer period of time, and we do not wish to expose ourselves to market risk at the end of every year. So there was an option given to them that they can opt for an irrevocable option, that they can also option to classify as fair value through OCI. Now what is fair value through OCI? This is a new term in IFRS. Fair value through OCI, there is a separate statement within the income statement. Income statement is divided into two parts. One is profit and loss account and one is other comprehensive income. So if I talk in a layman's language, the operating activities of the business, the business which are controlled by the chief executive officer or the CFOs who can control the day-to-day activities, their performance is measured through P&L. The events or transactions which are not in direct control of them but happen because of being in the business, they are routed through fair value through OCI, like unrecognized actual gains and losses, like this change in value of equity instrument which is classified in the form of fair value through OCI, or a revaluation gain which is not in the direct control of the management, which is according to market forces. So we show it as part of OCI. It may be exchange differences on translation, so foreign currency translation reserve also forms part of OCI. So there are limited number of items which are shown as part of OCI, which also means that they are not in direct control of the management. Though IFRS doesn't mention that they are not in direct control of management, but as a layman we can understand that the income statement is divided into two parts. So in financial liability, we do not have to decide whether we wish to keep that financial liability or not, but we can decide whether we are holding something for trading or not. So mainly in case of financial liability, since we plan to limit our risk, most of the financial liabilities are at amortized cost. Few of them can be at fair value through P&L if you are holding them for trading, and if there is any risk, Then depending on the credit risk and depending on the market risk, there is a component which can also be shown as part of fair value through OCI. So our methodology will be that we'll be first learning the standard from a different platform. We'll understand the nitty-gritties of it in advance. Then I'll take you through the presentation. After the presentation, if there are any further questions left which are unanswered, then we discuss them after the session is over. And we also do some practical questions in the real life, which are applicable in the real life or which can be tested in the examination. So also share the exam techniques relating to them. And then finally we compare the differences with Ind AS, IFRS, any difference which is still pending. What is the difference between the previous standard? If I talk about IFRS 9 financial instruments, so if I discuss financial instruments, I'll also be sharing which were the standards which has gone. Like IAS 39 financial instruments is withdrawn today. It has been taken over by IFRS 9 financial instruments. If I'm talking about the standards on revenue, I'll be sharing the background that which all standards are going away. Like IFRS 15 revenue from contracts with customers is a new standard in the market and is being implemented around the world from 1st January 2018. IFRS 16 leases will be implemented from 1st January 2019. Now to the audience who have already studied IFRS or to the new audience, they'll always be confused which were the standards which are going away, why they're going away, and what is new in the new standards. So we'll be taking you back always. Even if I'm discussing consolidation, I'll be sharing with you which were the standards which were applicable earlier. Like IAS 27 was the standard which was for consolidated financial statements. It is being replaced by IFRS 10 consolidated financial statements. IAS 17 will be replaced by IFRS 16. IAS 18 is already replaced by IFRS 15, and IAS 11 replaces IFRS 15. There are many interpretations as well which are being replaced. Now there are a lot of questions like what is IAS, what is IFRS, is IAS and IFRS same, how is it different from Ind AS, shall I learn only IAS or shall I learn IFRS? We'll be giving you complete details around all the standards, all the interpretations, all the guidance material which is coming from IFRS and what you should learn so that you are up to date and in your accounting knowledge which you can apply around the world, how it is differentiated with different countries around the world, and how the Singapore GAAP is different from IFRS, how ANZ FRS is different from IFRS. So we'll be sharing all the details. So that's how we are going to embark on this journey of IFRS, and hope you'll really enjoy getting the insights, because I have been part of learning IFRS since 2009 and have been learning it in detail, having part of the teams who have been implementing Ind AS in the country, have been supporting them, have been guiding them, have been training throughout the country whosoever is implementing Ind AS. So through this experience we'll be able to share a lot of insights, a lot of perspectives on IFRS and how this is still relevant, like something which has taken around more than 40 years to get implemented around the world. I believe this is an opportunity which is going to stay for at least 40 years, and if it stays for at least 40 years, I think our job is done. And if we can take advantage of IFRS to upgrade our career and skills in the next 40 years, we should go for it. So we should not be someone sitting on the corner knowing that people are doing IFRS, people are pursuing this course. You wish to do it, but you do not know when. Now is the right time, because if you wake up in 2025 and you tell people that you need to learn IFRS, then, and if you are into the job from last 15 years, then people will wonder where were you and have you woken up really. So it's still the right time to wake up and pursue a course on IFRS which can equip you with the required skills in the market, not only within the country, but you become employable around the world. All the best wishes for your career. Thank you.